trying to understand what you're actually seeing the retail investor do in this market. Do you think that the retail investor is what's actually taking this down, or right now it's institutions?
Well, I don't think it's necessarily the retail investor taking us down. It usually is institutions in this, kind of action. But what I will say, Andrew, is that the retail investor has been quite a bit, as you've talked about, a lot more reluctant, if you will, to be involved for a number of reasons. The inflation, as you guys have talked about all morning, geopolitical crisis going on. And let's face it, it's just not stocks. It's across the board where you're seeing a lack of buyers. We went through this whole period, and continuing through about 6 months ago, where it was a buy the dip mentality. The buy the dip mentality has certainly disappeared. The retail investors haven't necessarily disappeared. They're just engaging less. Many of them, because they're going back to work, don't have as much time, et cetera. And I also think that many investors who've come into the market over the last couple of years, as we know, skewed younger, which is wonderful longer term for the markets. But many of them have never actually seen a down market before. So I think that that's causing people to take a step back and say, what do I do now? And then the final thing I would say is there's no true catalyst type story. We went through this long period of time where there was a different sort of story stock, if you will, coming out with positive news. Well, unfortunately, as you guys have been reporting, there hasn't been a whole lot of positive news on a lot of stocks recently. And with the recession, et cetera, I just think that many retail traders are looking for a catalyst to get them to, put more money back into the market. So I think
we always try to
go ahead.
We always try to play a little bit of a history game in terms of trying to comp this against something else. You go back in history. You've been around a while. You've seen how the retail investor has lived through various cycles. Which cycle does this look like to you?
Well, I would have to say, Andrew, it's probably more toward the end of the 2008 cycle, because we went through a period where people were still engaging. We're still seeing clients engage. Let's face it, if you look at the numbers, they're still better than they were before COVID. We're not at that high we saw a while ago. So after 2008, sort of the worst of the news came out and people were a little bit unsure. They started to nibble, if you will, at stocks. We're definitely seeing people playing some stocks. I thought yesterday was interesting, and that many of our clients either bought Target outright or sold some out-of-the-money puts, because what's happening now is it's not necessarily people are going into the market to buy the overall ETFs, et cetera, or the indices. They're still staying with some individual names that they think things are being overdone on. Joe started the show today talking about VIX, and the fact is we haven't seen that panic in VIX at all in volatility. Right now, trading about a 32, which would imply a 2% move per day. That's not crazy as we've seen before when we see bottoms. And I think one of the mistakes many retail investors make is they say this is the bottom and kind of go all in. This is the type of market where you have to think average price more than ever and say, okay, where can this stock reasonably move over the next few months? And, to say we're definitely hitting bottom, this is the signal for the bottom, no horn goes off. So overall, I think that putting a little bit of money to work at a time is really the most important thing a retail investor can do right now.